Let's just start out with who I am. I am Aaron Cofira. I am a partner in the Professional Excellence division here at Bonadio. I've been a partner for about 7 years now, so time has flown for me quite quickly. I spend a lot of time doing a lot of the QC reviews for the not-for-profit side of the house, as well as some employee benefit plan training items and training matters throughout the year on an annual basis. And so what I've been tasked with today to spend the next hour with you is kind of going through some of the more bigger issues from a not-for-profit that are impacting you as clients with regards to mainly the PPP loan. We're going to talk about some long-lived asset impairment items, because that's probably going to impact a number of your organizations on this call. And then we'll kind of go through some of the accounting updates and highlights, if you will, on the back end of this presentation. The good news has been, from a accounting perspective, there has not been a significant number of new accounting pronouncements that have been issued in the past year. And if they have been issued, they basically have been delaying a lot of the pronouncements due to COVID-19. So I think that's definitely a positive of everything that is going on in this pandemic, that there's not a lot of accounting matters and accounting issues that we do have to deal with. Unfortunately, the biggest one that you'll see on here will be the leasing standard that has been deferred. And unfortunately, for a lot of the kind of a bond obligor clients on this call, you may have already adopted it, so you actually didn't get any relief, unfortunately. So, but that's neither here nor there. We'll just kind of talk through it. Again, this is my overall bio, if you did want to refer back to it. One thing of note, I am kind of the technical quality control partner here at the firm, and one thing that definitely is important is that whenever I come out, they try and keep me in the office a lot, and so anytime I get a chance to talk, they like to put up a disclaimer, because they don't know if what I'm gonna say, or if it's gonna get anybody in trouble. So this is our standard disclaimer from a firm perspective. These are my opinions and not the opinions of necessarily all of the partners or of other members within the firm. So that is our disclaimer for this presentation that we'll hold. Hopefully it is consistent across the overall practice, and there should not be significant differences, but hey, it's out there in case you need it. Okay, a couple things. I think we touched on everything here. We're going to spend the bulk of the first part really going through COVID-19 and the overall impact that it's having on our organizations and our clients and what we're seeing. And then again, we'll get into the SASB update. So with that, we're going to go ahead and we are going to launch a polling question here. Before I do that, just as an aside, there are 4 polling questions. You will need to answer them all and stay on during the duration of the presentation in order to receive CPE credit. So if that is something that is important to you, I just make sure that you are answering these polling questions as they come up. So with that, we're going to go ahead and start out with the first polling question here. Okay. Okay, so the poll should be open. And the main question here is where are you located? So we've got obviously the four major cities across here, and then in other, just to get a kind of sense as to where everybody is located here. The better question for today would have been how much snow did you get? When I was pulling this together, there was no snow on the ground. It was green grass in the last 2 weeks, and this seems to have changed drastically over the last 24 to 48 hours for a number of us here, as this snow front has moved in. So it's a little bit of a different winter than what we're kind of used to here in upstate New York. So, okay. So as the questions come in, I think there's a lot of it's kind of a good mix between Rochester and other, and I think there's about 23 people that have not started with the poll. So I'd like to just pause on that I'd rather make sure everybody gets their CPE. There's about 15 seconds left on the poll before it will close automatically. So please do keep that in mind, that if you do want your CPE, you definitely have to answer these individual polling questions. All right. So we are done with that, and now we're going to move on and get right into it. So I think we all know what COVID-19 is and what COVID-19 has done just from an impact on our overall lives. You know, back in March, I think we all didn't expect this to be where we are, or maybe we did expect it, seeing what was going on in China at the time. I remember watching it on TV, and it was just kind of like I was just sitting there watching it and seeing all these lockdowns in Wuhan and being like, there's no way the U.S. would ever potentially lock down as a result of this. And then lo and behold, it did lock down. So interestingly, in some way, shape, or form. So interestingly enough, obviously COVID-19 has had a significant impact on the overall business climate, the overall climate that you are all operating in as an organization. And for some, it may be more paramount and might have hit you more than others. Like, so for instance, if you are a nursing home, there may be, you might not have experienced any sort of closures or anything like that per se, whereas other entities like a restaurant or a hospitality industry definitely was impacted through a lot of that. And so that's a nice segue into the next component of this presentation, because what are we looking at from an accounting perspective? As everybody's aware, there was a major push by the federal government to try and keep the economy going and keep the economy rolling along through March, April, May, June timeframe, even though a lot of things were shut down. And so part of that overall initiatives that were sent out was obviously the CARES Act, and then the newest act that just was passed in December. But the one big thing that came out of the overall CARES Act was these PPP loans. And a number of these overall PPP loans, the accounting for an entity that needs to consider, there's different models that you can consider as part of the overall accounting. And the loans that were given out were also given out with the full intention of them being forgiven. And so there's some ramifications with regards to that forgiveness, and the overall accounting models may drive when the recognition of that individual loan it will be forgiven, or what the case may be, depending on where and how you're interpreting the overall forgiveness component and aspect of that PPP loan. So the three models, just at a high level, and we'll get into more detail on them, are really the ASC 470 model, which is just the normal straight up debt model. You're going to treat it as debt, and you're going to go on your way. And then there's the ASC 958-605 model, which is really ASU 2018-08. Oh God, he's getting technical. Let's slow him down. Basically your contribution model. So that's the most common one for not-for-profit entities, right? Because we are in a not-for-profit world, and that's where we operate, and that's what we understand. So a lot of you on this call, you probably will be going down that model. Just know you have the choice of using either the debt or the contribution model that's being referred to here. There's a third model, the IAS 20 model, which is the IFRS model, which we'll talk about in a little bit as well as part of the slide presentation. So from a single audit perspective, I will be very upfront. I am not a single audit expert by any stretch of the imagination. It is not something that I am 100% gifted in, let's say. It's not my thing, all right? But that being said, I can tell you that the PPP loans will not count towards the $750,000 threshold that your organization would hit and trigger a individual need for a single audit. So PPP loans are out of that determination. What is not out as part of all of this funding was a lot of the provider relief and HHS funds. So we see this as a potential sleeper issue for a lot of our clients because in the past, a lot of organizations may not have received a significant amount of these funds or relief per se. And so now with the provider relief funds that are flowing out, oftentimes it's getting close to that $750,000 single audit threshold and trigger that may be now imposing a single audit on your organization. So definitely something to keep in mind as you go through your year-end close. If you start to see a lot of provider relief fund as you're getting close to that $750,000 mark, you may want to reach out to your accountant and kind of raise the flag that there may be a potential need for your organization to get a single audit in the current year. One thing I will note is all of these presentations are being recorded, and on Monday, actually, there was a single audit presentation that was done by Heidi Bressler and Nancy Snyder, and that is available on, or will be available on YouTube, I believe, and the link will be sent out as part of that, as part of the communications that are going out. So you would, if you need to refer back to that at a future date and time, if you do determine that you do need a single audit, that presentation is definitely available for your viewing as well. So with regards to picking one of these models, if you do the ASC 958 model or the debt model, really the accounting is going to follow what that model is. So if you pick the debt model, it's going to follow debt. You're going to have debt on your books, and once the SBA provides your financial institution where you received the loan from, you would then recognize the forgiveness of it at a very high level. The contribution model is slightly different in the sense of you would hang it up as a refundable advance, and as we'll talk about down a little bit in a few moments, wherever you determine that the barriers have been overcome from a compliance perspective, you would then recognize that refundable advance into your overall income and operations. And along those same lines, from a cash flow perspective, it's important to note that the cash flow will, again, same kind of concept, follow your overall accounting model. So if you're following debt, you're going to show the inflow of these funds as financing, or if you are following the other model, you're going to show it as operations, because the expectation is these funds are going to be used in your overall operations. So again, some things to think about, some considerations as to how you want to present it on your or within your financial statements. Definitely some decisions that need to be made. Now, as we kind of step back from the PPP loan, it's not an automatic trigger. I don't want you to think I have this slide or this bullet on here that speaks to the potential impact on your auditor's report or your accountant's report if you're only getting a review, and it's talking about this going concern concept. I'm not saying that because you got a PPP loan, you can now expect potentially to have to worry about a going concern opinion in your auditor's report. That is not what I'm saying here. What I think the point here on this specific spot is just to remind you that as you begin to prepare for your financial statements, and if you, depending on the year that you have had, if you've had a relatively consistent year in the years past, and you haven't had going concern issues, the expectation then you probably could have would be that you're not going to have a significant issue from a going concern perspective. The flip side of that would be if you have had significant drops in revenue, significant issues in meeting your mission in the current year, significant closures, then it does start to begin to call into question, will you be around in a year if all of these programs are being cut as a result of COVID-19, and there's a potential quote unquote doomsday scenario for you and your organization, that this may be something that will be impactful in the current year from an auditor's report perspective. I definitely encourage open dialogue between yourself and your auditors, just to ensure that if there is the potential for going concern, that you're addressing it early on in your audit process. I think a lot of times organizations won't really focus on it, and it really becomes a a very stressful conversation for both management, the board, as well as the overall auditors. So again, just because you get a PPP loan does not mean that you're going to have going concern. It's just something that may be of impact to your organization as we move along here. Okay, so those charged with governance. Why is this important? Because of COVID-19. I think there's a couple reasons why that I want to kind of highlight here that are not necessarily new this year, but maybe a little bit different. From an auditor relations and management perspective, with COVID-19 and the loss of revenues, it may bring up these going concern discussions that perhaps did not happen in the prior year. So in the past, you may have you received good money from the state. Grants were not an issue. Contributions were acceptable. You had no potential items that would identify a going concern issue or anything like that. And so as an auditor and you as management, there was no difficult conversations, let's say, that had to occur. As a result of COVID-19, that may have changed, and it's no fault of yours and no fault of the auditors in this situation. And ultimately, the auditing standards have come to a certain spot that if there's certain indicators in financial statements, there may be the potential of going concern that now needs to be evaluated from an auditor perspective. So if you start hearing unusual questions from your auditor that maybe they haven't asked in the past with regards to cash flow projections or other sort of cash requirements, that this is maybe where these individual conversations are coming from. In addition to that, there is obviously the potential for increase for representation, items included in your representation letter. And I would probably venture a guess that the majority of these are going to be surrounding the PPP loan and the overall meeting of the individual PPP loan requirements in order to take out those loans. They're very complex. The rules are very complex from a employee item, and I know there's some other presentations that are going to go through some of the PPP loan information and the overall accounting or the reporting of that from an SBA and from a forgiveness perspective, which I won't get into as part of this. But definitely something to be aware of, that there may be some new things in your representation letter specific to COVID-19, not only the PPP loan, but maybe some of the other items that we're going to talk about as well, such as the accounting of those individual PPP loans. The other thing that may be a little bit different in the current year will be surrounding the understanding of the risks for your overall organization. And so it's not necessarily going to be, it might actually, like I touched on earlier, it might be more driven towards your cash flow analysis and what is your cash flow looking like in the current year and in the future. Really generally driving towards what has COVID-19 done to disrupt your business, and what are you as maybe a board member or you as management doing to ensure that your overall business is going to be financially viable and financially healthy on a go-forward basis. So just keep that in mind if some of these questions that are coming out as part of the overall accounting are a little bit out of unusual in the current year or different. It's always good to have that open dialogue as an auditor with both management and the board. On this slide, these are the three options that we kind of talked about that are available. There is option 3 is not available for not-for-profits. So I will steal my thunder that I was excited to have as a slide a little bit down the road, but I'll talk a little bit about IAS 20 down the road. At a very, 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 very high level, because you as a not-for-profit organization cannot utilize that as the potential accounting for the PPP loans. So let's talk about specifically with regards to the debt model. What is the debt model? Basically, when the cash comes in, you debit the cash and you credit debt. And it's at a very simplistic level, that's all you're doing. There's a little bit of analysis that will need to be done from a short-term, long-term calculation, various policies that may need to be elected if you decide to treat it this way. But at the heart of it, it's really you're treating the PPP loan as debt. And so what that means is that you probably will have that debt on the books at year end. I'm gonna go into the assumption here that for the bulk of everyone on this call, you're reporting at year end. And so depending on where you stand on the forgiveness scale, if you have submitted or have not submitted, you may or may not have received any sort of indication yet as to if that is going to be forgiven from the SBA and the financial institution. And I know there's timelines in the sense of, it's 60 days for financial institutions and 90 days for the SBA. That window may be shorter for some, in the sense of we have seen instances where certain one of our clients have received a PPP loan, they've submitted for forgiveness, and they actually have received a waiver from the SBA. So we have that situation where it all happened in 1 year, and that's great because that is super clean accounting for everybody involved. It doesn't matter what model you chose, it's done. For the bulk of the other clients, for the majority of our clients, so I would say that we have not received any sort of forgiveness yet, or it's in the process of forgiveness. So they have applied for forgiveness or they haven't, and if you have, a lot of times most of them are still waiting. So what happens if you apply for forgiveness, let's say on 12/31, and on let's say January 31st, you receive notification that it has been forgiven. So ultimately, you're free of that liability. What the accounting guidance is telling us and telling the overall practice, or I'm not the practice, the overall industry, is that is not a type 1 push it back event. So you will have the debt shown, and it would be a type 2 event if the amount's material. And you would go ahead and just disclose the fact that you have received forgiveness as it relates to the specific debt instrument. But there would be no accounting as of 12/31 other than showing the debt on the books, regardless of that forgiveness, because that forgiveness was received subsequent to year end. So it's really coming down to waiting for that overall legal release prior to the recognition of that forgiveness and the overall loan into income under the debt model. One item to note surrounding the debt model is there may be some debt covenant impacts that you have to be concerned about if you have other debt instruments out there that maybe have certain covenants that say you cannot obtain new debt. Depending on the financial institution and their read of that covenant, the PPP loan could be considered new debt, and as a result, you would be in violation of a debt covenant. Seems very punitive to me to say that would be the case, but something that you may want to consider and think about if you do decide to hang it up as a debt item. So let's talk about the next option that is available, the conditional contribution model, 958-605 ASU 2018-08, as it's more commonly known to the world, right? I mean, ever since this went to this codification, I have no idea where anything is anymore. I used to know FAS 13 was the lease, but now it's the leasing standard, and FAS 98 knew all that stuff. Then they went and codified it, so now I had to rejigger everything that I knew, and now it's ASC 840 or 840, and then 842 is a new one. So everything changed with the ASC. So now everything used to be ASU 2018-08, you could say it, but ASU 1808 actually is included in the ASC of 958-605. What do you do with this? If you are under this model, how do you account for it? And as we kind of talked about earlier, you hang it up as cash and then you credit it out almost like a deferred liability. It's a liability on your book. So under either the debt model or this model, you're still showing debt, or let's say not say debt, let's say a refundable advance. It's still hung up as a liability on your financial statements. But the overall accounting is slightly different from the recognition of it and the timing of it. And let's kind of talk through what that kind of looks like. There's two of these bullets on here are interesting. Maybe it's on partial recognition or full recognition once forgiven. So the full recognition once forgiven, we'll kind of go through that in the overall interpretation, if you will, that needs to be made from submission of forgiveness. The partial recognition comes down to the fact that, as everyone knows, with this loan, you are able to slowly bleed out, or potentially bleed out, the loan into income if you are maintaining overall headcount, if you're maintaining or utilizing those funds to cover expenses that are what the point of the loan was for. If you can demonstrate that, it's possible that maybe you could recognize that over the life of since when you got the loan through your end, depending on when those expenses were incurred and were covered by the PPP loan. The one interesting thing on that is you could potentially have some timing delays if you didn't cover all your expenses with that. It may slip year ends. Generally, we saw this early on in the year, so we saw it with a lot of our 630 clients, that there might have been some overall slippage and some timing issues specific to that as it related to cutoff kind of thing. I think for the most part at year end, most of it is known as to if you've done the expenses and if you maintain headcount and that sort of thing. But back in June, the issue was potentially there that it was not known, and so there was a little bit of potential some timing recognition and partial recognition and timing issues associated with these overall accounting and loans. Now, applying for forgiveness. This is a interesting item here. And why is this important? Because depending on your organization's interpretations of conditions and barriers, you may treat the final barrier of needing to submit for the approval of the forgiveness of that loan as a barrier. And as a result, you would not potentially recognize any of this until you have received the waiver from the SBA to say that you are no longer required to pay back the PPP loan. And so there's a lot of discussion and within the overall accounting industry as to, is this barrier of submitting to receive the waiver to not have to pay the loan back, is that enough to hang it up and say, no, you cannot recognize that full refundable advance until you receive that? And a lot of it is very facts and circumstances driven. So unfortunately, I can't give you a hard line answer to say this is the way it is because it's the way that it's been interpreted or anything like that. There is a lot of different discussions that go into it. Some organizations are viewing the barrier as that being a weak, since it's a legal requirement, that until they get that waiver similar to the debt model, they would not recognize that refundable advance until it has been received. Others are saying, no, that is not a barrier as part of this PPP loan. And as a result, it's kind of expected that we're going to be forgiven, or we know we've met everything that it's required for us to meet under the employee retention credit or the employee number of headcount and expenses, and therefore we're going to go ahead and recognize it now because we're comfortable that it's not really, I think the specific term is administrative. It's just more administrative more than anything else. So we're going to go ahead and recognize it now. So I encourage you to talk to your accountants on this one or your engagement partner, just to make sure that whatever decision that you make is going to be consistent with the overall interpretation that maybe they have, or for your organization it is the appropriate way or makes sense to recognize it. Because I'd hate to see you do it one way and then have the accountants come in or the auditors come in and say, no, that's not the right way because of these different factors that impact your organization, and then you have to go back and go through and retool your financial statements and your overall trial balances and that sort of thing. So just hopefully try and save you a little bit of time from that perspective. Okay, what you cannot do is apply IAS 20. IAS 20 is IFRS accounting for government grants and disclosures. Why can you not use the IFRS model? The reason why is because we in GAAP have a how do we account for government grants, and that's the contribution model. So this is specific to not-for-profits though, because if you are a for-profit entity, which nobody on this call I don't believe is, but if you sit on any for-profit boards and you hear them say, we're going to use the IAS 20 model, they can do it. Because for-profit accounting, there is no, how do I account for government grants? Don't forget that 958 little note on the codification thing actually says that's not for-profit accounting. Here's how you account for it. That doesn't exist in for-profit world. So for-profits can do this IAS 20 model, which allows them to look at probabilities of getting it forgiven, et cetera, et cetera. So there's a lot more to it from a commercial entity than it is a for-profit. Not-for-profit, you're limited. You cannot do it. You have to use either the contribution model or the debt model. Okay. So segueing away from the PPP loans and over to some other items or other matters to consider as part of COVID-19. I think I saw one place that in 20 years, the question is going to be, what year did COVID-19 impact everybody? Everybody's going to think that the 19 is the year, when in actuality it was actually 2020. But having lived through it, I have a feeling that none of us will forget 2020 for what that's worth. So a couple things here to note of if you did have sick pay or other benefits that came about as a result of COVID-19, that you allow people to vest or take vest vacation that maybe you didn't in the past at year end because of COVID-19. Those amounts now may need to be recorded within the financial statements if there is a benefit to be provided in the future. So something to think about as well. And sidebar on that, if you do have like an accrued vacation, don't forget the FICA tax on it. You also need to accrue the FICA tax on it too. That was always my favorite little audit adjustment that I used to always come up with. So anyway, post-employment benefits. So let's say that you let go a number of your workforce, and as a result, as part of that, the incentive to incentivize them, you gave them certain benefits and that sort of thing. You may, I'm skipping down to special termination, you may have actually created a restructuring plan that you have to consider, and that may be recorded, and there might be some accounting implications if you have a restructuring plan. Jumping back to post-employment benefits, if you had let's say you have a pension plan or an OPEB plan, and let's say you either froze the plan in the current year, or if you had a frozen plan, you also went ahead and settled a lot of the liabilities in that plan to take advantage of COVID-19. I don't know if you can really take advantage of it, but maybe you wanted to freeze the plan, and as part of your cost savings, determine this was the appropriate way to do it. There's potentially some accounting implications with regards to the curtailment of the pension plan or the OPEB plan, as well as the settlement of those individual pension and OPEB plans. So that's something to keep in mind. Restructuring, we did talk about a little bit. If you have any special one-time payments that were made for individuals to potentially early retire, those maybe need to be recorded in your financial statements if they're expected to be paid out in the future, and there's still different individual contracts that are tied to those individuals that maybe wouldn't have been there in the past, but COVID-19 forced your hand a little bit as part of your organization to do this. The next item on here is the contractual termination benefits. This is really coming around if you had a lot of retail space or a lot of apartments or something along those lines, and you potentially, let's say, exited those leases and broke the lease. If you incurred various lease charges as part of those breaking of the leases, it's very possible that you now have created a liability if you have to pay out in the future those individual leases, lease contract terms, and are not utilizing that space. There may be some additional accounting because of those lease contract and lease termination costs that might be working out there for your organization. Okay, so now it's time to go to polling question number 2. Poll number 2, let me go ahead and open it up. is which of the following statement best describes your thoughts on impairment? So this is going to deal, we're going to talk about now, probably for the next few minutes, long-lived asset impairment. And so the first one is, I have dealt with impairment numerous times and are comfortable with the topic. I do not think it will be an issue I need to deal with this year. And then 3, this is new territory and I am concerned. So as the results are coming in, I do want to update that the winner of the snowfall total this past little snowstorm we had is 3 feet up in Potsdam, New York. So congratulations on that. You win and you guys can keep it up there. My mother-in-law lives in Malone, so I will be sure to check on her to make sure everything is okay up there. But that is a lot of snow to have to move. So God love you up there. Okay. So for the bulk of the people on this call, and as a reminder, please ensure that if you do want CPE credit, that you are answering these individual polling questions as we move through here. The bulk of the people do not think that it's going to be an impactful in the current year. And so listen with an open mind and see if I can, I don't want to convince you that maybe it's going to be an issue, but I just keep in mind that there might be some potential triggering events that have occurred as a result of the pandemic. And the one thing that I do want to note here is when I talk about long-lived assets, I'm not speaking about goodwill. So it's very rare for a not-for-profit to have goodwill recorded in their financial statements. I will pause and say here that the good news is that there is potential relief for entities that do have goodwill on their books. The FASB has recently taken up a ASU, and they've kind of quote-unquote fast-tracked it, if you will, to a certain extent on trying to get through a ASU that would allow goodwill impairment to have to be done at each reporting period, which would mean 12/31 for a lot of calendar companies, versus having to do it when the triggering event occurs, which is what has to happen here for a long-lived asset when it comes to if there's a triggering event. That's when you go through and you assess your overall potential for impairment as part of it. For this ASU, though, the one thing that they have not said is that they did not include intangibles or long-lived assets as part of that impairment model, and that some of the comment letters that I did see out there did mention to the FASB that if they could somehow weave in some potential relief for the overall long-lived asset impairment, that would be definitely appreciated by a lot of people and a lot of practitioners and organizations, because it's very troublesome sometimes that to have to go through this overall calculation, if you will, that we'll kind of talk through, and very difficult to kind of project out when things maybe were not as bad as a result of the pandemic. Things shifted. So let's just talk about that a little bit, because I seem to be stumbling over my words a little bit. For the most part, the organizations are going to identify the triggering event of COVID-19 as a triggering event and need to evaluate long-lived assets. I'm going to say most. Let's take a look and think about what organizations would not potentially have to look at this from a triggering event. Maybe it would be nursing home facilities that stayed home or stayed open throughout the overall during the pandemic. Organizations that I have heard anecdotally have had the best year that they've ever had. Their services were really needed over the past 7-8 months, and there was no interruption. There was no drop in revenues, and so while that's positive, there are a number of organizations that didn't see that. Now, obviously, we know restaurants. We've kind of talked about all that, but from a not-for-profit perspective, you also have potentially, colleges and universities may have to consider this as part of that, with a lot of them going to remote learning. Hospitals, for instance, had a lot of elective surgeries that were canceled, which is normally a major source of revenue for them. So a lot of these organizations probably were and may have to identify this as a triggering event. That being said, there is a little bit of, I don't want to say there's a little bit of flexibility as to the determination of when is a triggering event. Sometimes it's very cut and dry. If a hurricane goes through on this date, you know it's this date, right? So if you apply that to COVID-19, COVID-19 really started mid-March. That's when a lot of the mandatory stay-at-home orders were issued. Is that the triggering event? I don't know. It could be March. It could be looked at as maybe it was more of a Q2 event. So Q1 being March, a March time frame, or maybe it was more of an April, May, June. Maybe everything was fine in through the end of March, but once April hit, it really had a major impact on your organization. So what you're going to have to kind of do is look at those individual indicators and make that determination on a case-by-case basis, depending on your facts as to what is the specific date that is the triggering event. What is that? Did it happen in Q1 or did it happen in Q2? Now, why is that important? Because why that's important is because the overall accounting models that you're going to have to do from an undiscounted cash flow model to determine if there is some sort of impairment will start on the date of that triggering event. So if you determine that, let's say March 17th, let's say for ease, March 31st, that's your triggering event date, you would start your projected cash flows from an undiscounted projected cash flows from April 1st forward. So if it's one of those things where your organization really didn't start to feel the impact until April, May, June, and then everything really ramped back up and went back to normal, maybe your triggering event is in June, and therefore you would not start your overall calculation until potentially July. All facts and circumstances driven, but there is a little bit of judgment determining that. The one thing you cannot do, and this is why it's important to make this determination as to what your triggering date is you cannot say, well, we were shut down in April, May, we got right back to it in June, July, and everything leveled off and we were totally fine subsequent to that. You can't look at that future and say, everything came out great at the end, we made it through, we survived, therefore we don't have an impairment. The accounting rules don't care about that, and that's why hopefully this new ASU will include some of the long-lived asset, will scope it in, because if it does, then we can sit and say, all right, as of 12/31, where are we? Do we have an issue? And did we have a triggering event? Versus having to go back in time and kind of come up with this undiscounted cash flow modeling based on a point in time 9 months ago when we know where we are right now. So it's a question that we get oftentimes, and I get it's like, well, why do I got to go back? The accounting rules tell you have to go back. It's nothing, not any specific driver or anything like that. That's really spot on. Now. Okay, there's a question that came in with regards to credit for each staffing and the tax as well as payroll taxes and that sort of thing. I don't believe that's going to be covered as part of this presentation. I would encourage you. There's another presentation I think that's coming out that's being taught by Jeff Paley, and I don't really know the specific name of that course, but I think he's going to cover more of the credits and that sort of thing from a payroll tax perspective. So I just wanted to address that real quick. Okay, going back to FASB 360 and the long-lived asset items, this is the specific point, if you will, as to why COVID-19 is probably a triggering event for your organization. There was a significant impact on your overall business climate. So that's kind of the driver. Unless you can overcome this hurdle as to say why it's not, then ultimately you may have a triggering event. Doesn't mean you're going to have an impairment, right? Okay, so what that means is that you have to go through some steps to determine if there is a to determine if there is an impairment. And we'll kind of look through, here are the jumping ahead real quick. These are the individual steps as to what they are and how they are, and how you go about determining if you have a long-lived asset impairment. But a couple things that are very important as part of that overall model is the first one, and it's really identifying that specific asset group. And what is that asset group? That asset group really comes down to, is there the lowest level of cash flows associated with a group of assets? Now, it could be, you may determine that the lowest level of cash flows available is your organization. Probably going to be rare. A lot of times I think we've seen it. I dealt with a case probably about a week ago where it was all in the PP&E. The PP&E drove what the asset was. Or drove the cash flows of that organization. So you looked at it right at that undiscounted cash flow amounts of the PP&E, specifically tied to that specific group of assets. Again, we cannot overly consider the specific economic recovery. So even though, let's say, the economy has recovered, hopefully your organization has, you can't consider that as part of your overall modeling, if you will, under the long-lived asset impairment. One thing to circle back on that employee tax credit thing, that presentation is the COVID relief update, and that's going to be tomorrow at 2 p.m. Jeff Bailey will be presenting. Hopefully he will send me some sort of referral bonus for giving out information on his presentation. So anyway, hopefully that will address any questions that you may have with regards to that. Okay, so approach to the long-lived assets. So one, let's all go into the assumption that we've determined that a triggering event has occurred. Let's say we have identified the asset group, and let's walk through a simple example here of, let's say it's driven by the PP&E. And as a result of that, you're going to go through and do an estimated cash flows, an undiscounted cash flow model, and then you're going to compare it to the carrying value of that PP&E. So let's say in a simple world, we've got $500,000 of PP&E. We go through and we determine that our undiscounted cash flows based on the estimated useful life of the overall PP&E, and I'm simplifying this, it's $1 million, okay? Well, we can stop because the expected cash flows are in excess of the carrying value, because the carrying value of the PP&E is only $500,000. If we turn that example a little bit and say, let's say it's $250,000 is what our expected cash flow is, okay? So now we have an issue because now our carrying value is $500,000, but we only expect to get $250,000 of the recoupment of the overall undiscounted cash flows. So what we would have to do is go through and value what that PP&E is worth. And so let's say we go through there and we determine that the PP&E is $250,000. Now I'm making this very simplistic, but in a simplistic world, you have PP&E in your financial statements that say it's worth $500,000. The fair value is $250,000. So therefore, you need to write down those fixed assets down to the $250,000. Ultimately, that's what you would do. You would take an impairment charge for the $250,000 and then you would debit the impairment expense for $250,000, and then you would credit the overall PP&E for $250,000. Therefore, your undiscounted cash flows will equal what you have from it, what you're carrying those financial statements or those PP&E on the financial statements at. So, okay, that is the overall high-level impairment loss from a kind of accounting perspective for it. It gets a little more complicated on that. And as a result, there is the allocation of the impairment loss example is here. If you have entities that have more than one long-lived asset, that's kind of talked about in example one. There's also some probability cash flows that you can go through and then some specialized equipment if you probably don't have. Okay, polling question number 3. Here we go. Okay, did your organization receive a PPP loan in the current year? Yes, round 1. No, you did not get one. Or yes, in round 2, you're expecting to get one, or you decided not to get one as an organization. So I know we spent a lot of time on the overall PPP loan as well as the long-lived assets. As I kind of indicated earlier, there's not a significant number of overall accounting updates that we have to kind of go through. So I will go a little bit quicker as it relates to the next 5-10 minutes here to make sure that we do get you out at 3 o'clock. I can appreciate your time is very valuable, and I don't want to keep you. I won't keep you past 3 o'clock. I'll definitely pick up the pace here momentarily. So with that, again, make sure you answer your polling question, polling question number 3, to make sure that you are getting your CPE. And with that, I'll let the poll just run out and go ahead and close. So for the bulk of the people on the call, the majority of the people did get a round 1 PPP loan, followed secondly by decided not to obtain the overall. Okay. So from a FASB update on this sheet is a high-level summary of the individual ASUs that are applicable and will be applicable for year-end entities. So just kind of like a little kind of cheat sheet, if you will, as to what potentially is going to be out there. For the first one, this is the premium amortization of purchased callable debt securities. If your organization has callable debt, all that this does is it shortens the window on that premium that you're amortizing, that window, to be the first call period. So if they can call it in a month, you're going to amortize that premium to the shortest period, which would be a month. That's pretty much all that this standard says, and really all that it does. ASU 2018-13, a couple things on this. This actually reduced a lot of what I think the FASB determined to be redundant or not really valuable fair value disclosures that were made in financial statements. Everybody knows there's a lot of fair value disclosures in financial statements on financial instruments, and a lot of times they're not really either relevant or helpful. So just kind of taking through some of these, the big ones here would be the first couple, first 3 probably, the amount of the reasons of transfers between level 1 and level 2. Nobody really cared, so the FASB said you don't have to worry about those. And the same for the policy of the timing of transfers. This is for both public and non-public organizations. What I've done on here is, if you see in parentheses non-public, that would be any conduit bond obligors. That would be impacting them. So, for instance, on this next slide, the clarifying of the uncertainty disclosures over measurements at reporting dates, that is for specifically for the conduit bond obligors, getting a little bit of relief here in the sense of they now, you do have to do something. You have to actually clarify, and you have to kind of communicate any uncertainty with regards to the measurements that you may be incurring in valuing your overall fair value items. Okay, a couple other items on here. The last bullet would be the change in the weighted average rates, just ensuring that you are disclosing any sort of any changes on that as part of the fair value table as well. 2019-03, this is kind of updated the overall definition for a collection. So there were 3 things that the collection, in order to be a collection on financial statements, that had to hit all of these individual items on the slide. The important thing to note here is the last 2 bullets. There are new disclosures on the policy of how you're going to use the funds that you get if you sell something in your collection. Will you use it for direct care, or will you use it to buy additional items? You need to disclose that policy. And further, you need to disclose what is considered direct care. And interestingly enough, a lot of entities are now selling off their individual collections, at least certain components of them. And this is important because this actually came out before COVID-19, but definitely has an impact on a lot of organizations because of COVID-19 with regards to having to disclose all this information, because now users will know what if you do sell a work of art or something, what are those proceeds going to be used for? This just issue 4B, this 2019-04 really was focused on the CECL standard more so than on 1601. The one thing it did do is it did eliminate the disclosure of any held to maturity securities that you do have. You would not need to record them and show them what the fair value is, the mapping of the unrealized gains and losses within the footnotes, you could just say these are held to maturities because the expectation is you're going to hold them for the overall life of the security. The last item on here, or the second to last item, is a move to dealing with LIBOR. And if you have contracts that are under LIBOR, you probably have received notification from your financial institution that LIBOR is going away at the end of 2021. And as a result, there needs to be a new rate. This is just kind of going through some additional accounting implications and determining what you would have to do because of the change in the interest rate. For the most part, I'm hearing everybody's going to the SOFR rate. So this modification in the contract, you would continue with your additional existing analysis that occurred, even though there is a change in the interest rate. It's not a true contract modification per se, as well as any hedging relationships that you may have had tied to it. You can continue with your initial hedging accounting as well. The last thing it did is it allowed you, if you have any transfers, this is more of a for-profit issue, if you had any transfers between available for sale or held to maturity, you will not be screwing up your, or I think it's, the technical term is, you won't be messing up your overall determination on available for sale. If you move it to held to maturity, you won't taint your portfolio per se. The last one is the leasing standard. It has been deferred, so that is a good thing for a lot of not-for-profits as well as private companies. You have until the end of next year for calendar year 2022 to adopt this standard, as well as, and I'm going to go ahead and launch the last polling question here as well. And the question is really, what future topics would you like to hear more about? So I'll wrap that. I'll let that go while I finish talking about the leasing standard. If you had any sort of if you deferred leases last year and you were a conduit bond obligor, you still have to do it by the end of your 2020 financial statements. Will need to reflect the new leasing standard if you are a conduit bond obligor, if you did not already adopt it. I think for a lot of the CBOs, you probably have already adopted it, already had it included in there. So you may have chosen just to go ahead and adopt it at that point. If you had, then your financial statements would appropriately reflect what they reflect. You didn't benefit from this, but if you did not take advantage of it, do know that you now will need to go ahead and adopt it. So with that, I think we are almost at 3 o'clock. So I am done. I think there's only 42 people that have not responded. There's only 10 seconds left on that. And I don't think that there's any other additional comments or questions in the chat. So I think with that, I think everybody have a wonderful day, and we'll take it from there. Thank you very much.